Anton. Okay, good. Okay, good morning, everyone. My name is Paul Duran, and on behalf of the entire team at ELCO Management, I have the pleasure to introduce Anton Schutz, Dan Goldfarb,
Hello.
and Anton Schitz Jr.
Hey, Marco. How are you doing?
Hold on.
Are you?
Not quite.
At the mute. There we go. It's a pleasure to introduce these guys. They are our sub-advisor for the ELCO Financial Services SMA. And today they're going to give their outlook for the space, which is predominantly, the SMA is predominantly invested in regional banks, and their outlook for the macro economic outlook of the banks. So Anton, Dan, and Anton Jr., the floor is yours.
Well, thank you. I appreciate it much. I got Dan Goldfarb all prepared because I wasn't sure I'd make it back from the dentist, but it kind of was an emergency. So glad I made it back. First of all, let me talk about Dan and Anton Jr. Dan has been a mentor of mine throughout my career, so I'm really pleased that we've been able to work together since 2020. And he knows more about small cap banks than anybody on this planet. So great asset to the team beyond being a great person. Anton Jr., beyond sharing a wonderful name, spent a few years at Stephens doing investment banking. So he actually banked a lot of these small cap banks over a couple of years, and he's been with us since 2018. He has an MBA from Stern. I know he looks 20, but he's actually 31. So he's actually been in this business since he was 16 because he's interned for me. He's interned for KBW, Sandler, Patriot. I'm sure I'm missing somebody, but he's been around the street and around these small cap banks. So first of all, I'm going to let Dan do some talking in a minute, but I will say this. I came out of the Barclays conference when I was in New York for 3 days and meeting with slightly bigger banks, more I would say SMID to large. And there's a nice sense of optimism out there. And some of that optimism is around, the fact that loan growth is picking up and credit quality is good and the yield curve is getting better, right? All good stuff. And part of it is also the fact that we just saw PNC pay 2.4 times book for a private bank in Colorado. And there is more to come. And the fact that PNC is willing to buy something smaller, i.e. smaller for them is 27 billion in assets, and pay that kind of price is just a really great sign for the space. We've certainly seen Huntington active as well and doing large deals, and they've said they're ready for more. The regulators, which is really important, the regulators are singing a different tune. We had deals that would go for a year plus, right? I met with the company yesterday that literally had a deal. It took them over a year to close that transaction, and that was Columbia Umpqua. They just announced the deal a few months ago and have already closed it. So the regulatory environment is much better. So we're going to see companies do multiple deals a year. There's lots of appetite. I was with the CEO of KBW the other day, which is one of the biggest firms providing research and investment banking in the space. He goes, Anton, what do you think? I go, Tom, stop it. What do you think? And I know you know. So he laughed and I said, yeah, you guys are busy as hell. And he goes, yeah, we are. And we just spent a weekend in a distant spot in Canada with another investment banker. And again, it's on. These mergers are going to happen. So Dan, I'm going to turn the ball over to you, and then Anton Jr. is going to give you a few stats on the portfolio as is on top of that, and then we'll open it up to questions. But we feel very good about everything. We feel good about the environment. We feel good about regulations. We feel incredibly good about valuation. So Dan, ball to you.
Great. Thanks a lot, Anton. Good morning, everyone. A lot of times investors hear banks or financial services and their head starts to spin because debit's on the left, credit's on the right, and it's the exact opposite for banks. So I'll try to strip away the four-letter word bank and just call this a company. And the question becomes, would you invest in a company who has rising revenue, controlled operating expenses, and rising ROE, trading pretty much in the bottom half of historical valuation? And the answer probably is yeah. So that's where we are right now with banks. So I'll drill down a tiny bit and then let Anton Jr. go. The rising revenue is coming from two things. One is loan volume is picking up a little bit. There's always a lag between loan pricing and deposit pricing. As the yield curve goes from inverted to kind of flat to check marked to positively slope, what will happen is the cost of funds will come down as revenue continues to rise, driving top line. Also important with that last statement is that credit costs will not be rising unless we get a full-blown recession. But without that, which no one's calling for, all of those loans people seem to be afraid of, commercial real estate in particular, core business district that are refinancing between now and next year, actually won't be repricing that much more than where they were. Oh, by the way, rent roll is rising so it can cover the costs, and NOI is not going to go down by that much. Furthermore, you have control of expenses. I mean, we're talking basically inflation plus maybe. So that all drives rising ROE, which of course drives book value growth, which drives valuation, which drives M&A, which for now I will turn over to Anton Jr. because he's the master of M&A.
Thanks, Dan. But before I get into the M&A side and you talk about the tailwinds Dan just talked about as far as revenue and expense numbers, I just want to talk a little bit about valuation and the gap between big and small. And, for this specific product is mostly small. When you talk to generalist investors and, try to make the argument that banks are cheap, they're mostly looking at the big banks, right? So if I just look at my screen that's in front of me and I got, market caps above 10 billion, and that includes the big guys, right? JP Morgan trading at 2.8 times book and 15 times next year's earnings. The median is 13 times for this year and 11 times for next year for earnings. If I look at just our ELCO portfolio, it's 8.7 times for next year. So, a few turns of earnings in there. Not to mention that the upside for anything above 10 billion doesn't totally exist. There's a few M&A names in there, but not for big premiums like we could see in our portfolio. Same thing for tangible book. Big guy is 1.7, and it kind of goes down with market cap size. But big banks 1.7 times tangible book. The ELCO portfolio 0.96 is just the median of our portfolio. That number would be appropriate if we were doing 5 to 6% return on tangible common equities, which wasn't even the case when banks had a difficult operating environment. For all of 24, median return on tangible common equity was 10% for the portfolio, and it basically goes up 1% each of the next years based on consensus. So 11% next year, 12%. 11% this year, 12% in 26, and we're still trading below tangible book value, which doesn't make any sense. So that's typically a good area to be interested in bank valuation, right? When you're putting up actually decent returns and trading sub tangible book value for names that have more optionality. But the multiple gap that I mentioned, right, where you have big banks trading at big multiples and small banks trading at small multiples, is what allows for premium M&A to happen. Right, because that's just how the math works. If you have a superior relative multiple to a company that you're acquiring, you have typically better earnings accretion, typically less tangible book value dilution. So that gap allows for that premium, right? If everyone traded the same valuation, you have to rely on cost saves to be able to actually get earnings accretion. So we're just in a good setup as far as finding premium M&A, and we've already seen that come back, which is exactly what the industry needed, right? Because it was industry consolidates, it should be 4% a year, and it's been 2% or less for the last several years. And part of it's because it's like, why would I sell my bank, right? I'm not going to get a premium deal, and I'm not going to get a premium valuation. And now we're in a scenario where you can kind of have both. So to Anton Sr.'s point about M&A is coming back, some bankers are busy, absolutely, because we're seeing deals like this.
Right. Thank you. Anton, why don't you talk about our largest position, because it's really interesting. VersaBank is our largest position, and he used the word optionality, but we love lots of ways of making money. I'll only describe one of them, but these are several of our names in our portfolio are going to go into major indexes. Why? Because either the way they've listed or the way they've uplisted. So, two of our names that we've participated in IPOs on, literally in IPOs were just uplistings, names we know very, very well for quite a long time, are going into the Russell 2000. One is going to go in September, so in a week plus, it's going into the Russell 2000. There's a lot of stock to buy, and that's Coastal Southern. The other one, Avid Bank, is going to go into the Russell 2000 in the December reweighting. So at this stage, what happens when you go into those indexes? The index funds have to buy. They don't care about valuation. But oh, by the way, both stocks trade either at or below book value. So, we're in a great position. We like both companies' fundamental. We think Coastal is a potential takeover target. Private equity was trying to figure out whether they should take them IPO or whether they should try to sell the company. With multiples rising and more buyers being around, it's a nice franchise. So we have that optionality. We like the management, so we have operating optionality. And then we have the Russell 2000 component, which means, the price in theory will go up. At least there'll be a lot of demand. Volume will go up. Avid Bank is really going to fill the niche of what Silicon Valley did in venture capital. So they raised a bunch of money, not only to just uplist. We've known Avid for a long, long time. They're in the Silicon Valley area, having fresh capital and filling in a hole that Silicon Valley abandoned, which was the venture market. And it's a very, very good market. You make very good spreads, you get warrants, and credit quality managed properly. You're making plenty of money to cover, taking some degree of risk and lending to later stage venture. So, we like that company, but again, it's going into the Russell 2000, trades at tangible book value, trades at single digit multiples. So again, very, very good. Oh, I just saw a comment. It flashed on my screen. Someone said Silicon Valley's trying to make calls. So that's good that they're making calls, but they've been absent, and they've definitely been absent in the smaller credits. So it's really good to see that there's some competition out there with fresh capital. And I'll tell you, the buyer that took on Silicon Valley is a much, much more conservative bank. So when you're talking about a North Carolina bank trying to be in the venture business, not as easy, not as long. But anyway, we like Avid a lot. Trades at a very different valuation from a lot of other banks. So again, lots of upside. And by the way, the CEO is no spring chicken. Could this company get sold? Yes, not near term. Coastal Southern probably more nearer term, but we see plenty of catalysts in those two names. But our biggest name, VersaBank, Anton Jr., why don't you talk about some of the optionality that exists there beyond the uplist to the NASDAQ? They're going from a Canadian company to a U.S. listed company. They already have charters of banks in both. They're already dual listed in Canada, but the holding company will transfer to U.S. Anton Jr., talk about the fundamental reasons.
Yeah, I'll expand a little bit on that too. I think shareholder votes early 26 to re-domicile to the U.S., at which point they can be included in the Russell. Fundamental reasons, throughout Anton Sr.'s career, I'll give him a little bit of credit. He's been pretty good at identifying these types of opportunities where kind of a quality bank that's sitting there with a few different directions it can go on the fintech side of things. For example, and some of these companies have been not as great recently, but post IPO in their youth, right? Live Oak Bank, Triumph, and then one more were kind of just normal banks until they weren't, right? Until they had some fun fintech angle that was unexplored. VersaBank is one of those where it's got a nice business model in its point of sale lending products, and these are not the Affirms and Klarnas of the world where it's an online thing and there is no underwriting involved. These are at actual stores that are making loans out of the point of sale. The nice part is that in some of these agreements that VersaBank has with these retailers is that the retailers eat the losses. So there's never actually been a loss in that portfolio to this day. Part of the reason they expanded into the U.S. was just to get out of diversify beyond the Canadian economy, right? They still have exposure to Canada, but wanted exposure to the U.S. Obviously, things move a little bit quicker here. Bought a bank here basically for that purpose. had their first retailer come online and has already been doing a good amount of volume through that. And there's a ton of room for them to run there. So just as a standalone bank, there's some interesting prospects, especially given that it trades below tangible book and at a pretty significant discount on earnings. I think we're at 8x next year, and it's had a nice little run. So 8x is much higher than it was a few months ago. But on top of just its normal business, it's got a few other options that are interesting. So first of all, we can't go a meeting without talking about stablecoins right now. It's just the topic du jour for banks. And VersaBank developed its own digital deposit receipt. So it's not exactly a stable coin, but it's kind of a ledgered transferable deposit, but it's not anything related to the block, like crypto. There is a blockchain component, but yes, I just saw the question pop up. But it's something that's interesting. They're the only bank that is doing this, and they're currently in pilot. Right, Fiserv is already offering some product that is also really early days, and they've partnered with Circle. But VersaBank is the only one doing this, and it would just require OCC approval. That's always been an interesting call option here, right? Where it's like if they don't have it, that's fine. It's still a good bank that's undervalued, and no one's assigning any value to that business. They also have a cybersecurity business they built from scratch that I think they intend to sell at some point, which would be a nice just increase the tangible book value. They sell that product to other banks as well. But it's also an interesting play on the U.S. and Canada. I think it's one of the few smaller Canadian banks that's dipped into the U.S. And it's not exactly on anyone's written agenda, but it is possible in our minds that U.S. banks being in Canada could be a bargaining chip for Trump at some point. Just considering that someone needs to give somewhere. And Canadian banks can operate here, U.S. banks can't operate in Canada or have a branch network, collect deposits, etc. So that could be an option where VersaBank would be a good M&A target, given its unique business lines and the age of its CEO, who likes spending time in Florida. It could be a good M&A target as well, just considering that it has some particularly interesting niche business lines. It could fit well into a bigger bank, which is always the case for these kind of niche banks that have interesting things going on, right? Now, it doesn't make sense for a like-sized peer to acquire it or merge. It could tuck well into a larger regional bank. But all these things are, it's really hard to price some of the catalysts, like the sale of its cyber business or, its newly emerging stablecoin business. So we just think it's undervalued from that perspective, similar to how Live Oak wasn't probably fully given credit for its, digital strategy, or how Triumph wasn't given credit for its payments business, right? Early on, where these weren't identified, they're inexpensive stocks. These catalysts were realized, and then suddenly they're not inexpensive and had tremendous moves in stock price. So that's VersaBank. What did I miss? Did I miss anything?
You missed the deposit there. Believe it or not, the Canadian economy is not a great economy right now. Shocker. So they have a very large depository business that's related to bankruptcy, where basically they get the deposits, sort of like the opposite of debtor, dip business. And, the judges appoint them as the holder of deposits. They're not taking any credit risk, and they pay almost nothing on it. I believe they pay nothing. So that's the worse the Canadian economy gets to some extent, the better the cost of funds is. And obviously Canada's going to keep lowering interest rates as well as we will. So they're also liability sensitive. And then really here's the other one. So it's always nice to have demand for the stock, right? We talked about indexes. This is going into the Russell. Probably the timing is going to end up being either in March or June of next year. And it'll be a tremendous amount of volume that's going to have to get bought. But the company at book value, at single digit multiples, has excess capital and actually is buying its stock back. So they have a buyback as well. And that's another point about the entire portfolio. One of the things that hurt the banking industry was having bond portfolios, right? When rates were transitory, they're never going higher. A lot of banks, from a liquidity perspective, do own bond portfolios and some extended duration. Well, that's not been helpful, obviously, the last few years with higher interest rates, lower bond prices. That affects capital ratios. Banks are obviously getting some recapture there. And I think that's really going to allow for capital to be very strong. What do banks do with capital? They could buy back stock, they pay dividends, and of course buy other banks. So that's an industry-wide phenomenon. And again, those are all very good positives in the space where you've got too much capital or high capital generation going on. We still are seeing some restructurings in the banking space, right? So when we're going, let's take the pain, let's dump our bond portfolio that's yielding, 2%, and we've got 4% wholesale funding against it. Let's restructure, either pay off the funding and boom, obviously that's good. That's income. It's a one-time hit. Or let's go dump that. Let's go buy 5% securities, pay off some of our wholesale funding. So smaller balance sheet, more profitable, higher return on equity. And so some of these restructurings are attractive. So we've participated in a few of them. Is it a better bank? No. Is it a better earning stream? Yes. And does it make it cleaner for someone to buy it? Yes. So we may still see some of that. We obviously will participate in some of those capital raisings as well. But we're obviously cognizant of who put that in. So part of due diligence is who's running your ALCO committee now. What policies do you have in place not to extend duration again and take that kind of risk. But, that's part of our due diligence. And, we've all served. I mean, Dan served on bank boards. I'm serving on a bank board right now of a private bank. I run the ALCO committee. I mean, it's really important. Asset liability management is critical. In fact, we only have to look so far as our own Fed, which has done a terrible job of asset liability management and has lots of duration of its bonds and its portfolio. And unfortunately, rather than throwing profits at our deficit, they're throwing losses at our deficit because they're upside down. They own bonds that yield 2%, and obviously they're paying out Fed funds. So that's upside down. I expect that they're actually going to get better at it. I think there's going to be some better discipline there. This has nothing to do with the political stuff. This has to do with basic fundamentals of what should the Fed do. Should it be more aligned with our treasury process rather than being weighted towards the long end? So we also hope that not only do we get interest rate cuts from the Fed, that at some point they stop their quantitative tightening and dumping securities onto the market. It drains liquidity. It's not good. But I do think that'll come to the end. I think January at the latest will be the end of their quantitative tightening. Hopefully they wake up and go, yeah, the economy's slower. We shouldn't be doing this. We shouldn't be draining liquidity from the system. But again, we've got a positive Fed. We've got a decent credit environment. We've got loan growth about to pick up. By the way, tariffs have not been good for loan growth, right? To be very clear, companies do not invest or spend money when they don't know what the rules are. When the rules are clear, and they're about to get clear, hopefully, maybe the Supreme Court rule one way or the other, but we'll have some clarity. Companies will begin to invest again, spend money. But at the meantime, a lot of regulation is being reduced. So there's growth in certain industries out there, including financial services. But obviously the energy industry is another place where regulation is being reduced. And so there's positive operating leverage there. I'm gonna pause at this point. I think we've covered.
Hey guys, just quickly, this portfolio, 25, 30 banks, it's a big universe for you guys. Maybe you could hit on, you described some of the positive attributes of what you like to invest in, but what you also avoid in this space. Back in March of 2023, I think you top ticked Signature in our portfolio. You made money in New York Community Bank. You had no investment in First Republic. Maybe you could kind of just go through how you navigated that because it's still fresh in people's minds and what you kind of avoid in this space.
Sure. I mean, first of all, I think from a portfolio manager perspective, I bring something that I think a lot of portfolio managers should have and don't have, and then I have industry experience. I spent 10 years at Chase Manhattan Bank, and sort of thinking about some blocking and tackling basic things like balance sheets and deposits and ELCO, that's asset liability management. really come into play when you look at some of the things we've avoided. If you think about, whether it's Signature Bank or New York Community, the way they were funding, Silicon Valley, the way they were funding was upside down, right? They've got a lot of short-term deposits. They're putting a lot of long-term assets with fixed rates. When rates rise, you've got to pay much, much more in the way of cost of funds, and you get upside down. Like I just said, the Fed is upside down, and so it's a real problem when you look at opportunity. So avoidance of risk is real. So interest rate risk has always been a big one. I was a derivatives guy when I was at Chase, so certainly interest rate risk was big. I always helped companies mitigate that. But, interest rate risk, credit risk, political risk, right? If you're in certain geographies, some of those risks are bigger. If you're in places like California, where taxes are high and, all sorts of political things get done that can be detrimental to the business environment. Not that we won't own stuff in California, we do, but the stuff we own is niche and is going to take advantage of things. But yes, the avoidance of risk is critical. Again, take New York Community as the example, right? If you're lending money at 4.25% long term to commercial real estate and cash flows are going the wrong way and rates rise and your deposits are going to cost you a lot more, that's a very bad position to be in. So at the end of the day, doesn't your community have the losses it's going to, that people talk about? Probably not, because a lot of the keys aren't getting thrown. Again, credit is really critical. So if you take the example is if you have a $500 million, multifamily building in New York and the cash flows aren't so great. I've asked the CEO, I said, why don't they throw the keys at you? Well, here's the reason. You lend them 300 million, they're upside down. You know what the cost basis in those buildings are? It's close to zero, right? Between the exchanges and between depreciation, it's a $300 million taxable event if they throw the keys. They're not throwing the keys. So is it a non-performing asset? Yeah, they've got to put it that way because it's not cash flowing the right way. But the owners underlying that building aren't going to walk away. So it'll be an interesting investment at some point in time, but it was an avoidance because those headlines did what they did, right? They created fear. They created a recapitalization, a dramatic stock price. Maybe the FDIC was close to seizing it. It was close. Yeah, we don't love taking a lot of risks. So, we like the story where everything's pointing in our direction. And if there's a lot of hair on it, we're going to avoid it. So thanks, Paul.
Yeah. Maybe we could just kind of go through the queue here. And again, if anyone has any questions, please use that chat function. One of the nice things about our portfolio is we can benefit from the access to IPOs and secondaries that we have. So one of the questions here was, do you see more M&A in small caps versus mid caps?
Yeah, I mean, there's just that many more small caps, right? That's the thing. There's only a certain number of mid caps, and the mid caps actually have wind in their sails, right? They're going to be doing the buying. And in looking at some of those deals, the mid caps aren't getting hurt when they do the deal, right? When Huntington bought Veritex, it really didn't get hurt, but Veritex got the premium. And when you have a discrepancy in market caps, the premium gets kind of sticks. When you have a merger of equals, like we had with Pinnacle and Synovus, and people really didn't, the wrong shareholder base, that stock got destroyed. The math wasn't bad, but the liquidity was there, the ARBs could play, and every Pinnacle shareholder was there for the sale of that company, not for a merger. So you do have to think about the shareholder base of the company as you own as well. In terms of activity, capital markets activity, it's going to be very high. We talked to all the syndicate desks, and I told you I talked to Thomas Show the other day from KBW. Again, it's not insider information. I'm just asking about general business activity, but they expect a lot, and they do expect capital markets activity, i.e., capital raising secondaries related to M&A. So the bigger buyer probably needs a little more capital to complete the deal. We may very well own the target too, but it'll be a chance to buy that buyer at a discount. And it's always about whether the math is good, but the math is very good in the early deals. Just met with a bank again the other day called Old National, and they bought a private bank in Minneapolis, but they basically paid tangible book value for it. And they bought it back, earlier this year. And, their commentary is exactly, what you think. I mean, the early buyers get the really good math. And, given that gap that Anton Jr. talked about, where you're trading at 1.7 and your target's trading at 96% of book value, you can pay them a really nice premium, and the math still works for all shareholders. And that's a really good place to be. So, yeah, the juice is here today. How long will it take for that gap to close? Hard to say, but a lot of times the targets end up trading at a price that's above the buyer's price, and then the buyers pay too much, and then they get killed. But we got a long ways between here and there, and hopefully making some money. And oh, by the way, these companies continue to grow book value, so that even if the stocks don't move, the discount to book gets bigger. So there's, that nice return on tangible of 12% that we expect for next year in the portfolio. It's pretty strong. That's really nice book value growth.
The only thing I'd add is just, I think I could think of, Dan, you might have thoughts on this, like 10 mid caps that I would peg as sellers. And on a relative basis, that might be more of the universe than small cap. But small cap, there's probably 30 to 50 that I'd peg as sellers. But there's just more small caps. So relative basis, maybe more mid cap, but absolute small cap, we'll live in the absolute.
And the returns will be much bigger on the small cap deals.
Yeah.
I mean, that's a good way to segue into the next question, the queue, which was regarding, and Anton Jr., you mentioned you can't get out of a meeting without hearing stablecoin or blockchain. I guess, is that technological disruption in the industry helping to accelerate the M&A? Because I would imagine your standard brick and mortar, doesn't have the capital to invest in this new technology.
Yeah, I certainly think that it's causing people to think that way a little bit. We talk to boards pretty frequently, and there can be boards where it's like I couldn't fathom explaining to them what a stable coin is, right? So that they're not going to want to stick around for that. I think for some of these small cap banks that are in really small rural markets, or they're just really good at their business model, they're not going to care that much, right? Where it's like not having a stablecoin product isn't going to drive them out of existence within the next decade. But I think there are certainly banks, especially in the mid-cap space, where it's going to require a lot of technological investment. Your peers are going to be doing it, and it's going to be table stakes for most of your commercial clients, where that could lead you to M&A. Or leads you to a sale, where it's just like, this is going to be a lot of time and investment. We don't have the talent or the resources. We're not quite there yet, as far as it being like, table stakes for banks, where it's like, these guys are doing it so well, they're taking all of our customers. We're years away from that. But everyone's starting to, build the foundation for that. So at some point, the technological change will really drive M&A. We've kind of said that for a long time, and I think broadly it has. So big picture thesis, yes. Within the next year, probably not.
So I was just at a stablecoin dinner in New York the other night, and again, the conversation, 27 people in the room, young buck building a stablecoin company that's trying to be the Visa and MasterCard of clearing. But look, at the end of the day, you can make a lot of noise about this technology. What does a stablecoin actually do, and who wants it? You know who wants it? It's Walmart. They want to get paid faster, right? The credit card, you swipe it, it takes a little while for Walmart to get its money. It's any big retailer. At the end of the day, the consumer really doesn't care. What is this? It's not more elegant. It doesn't do anything. Where it really matters for a business is cross-border, right? There's a lot of friction when you do a cross-border transaction the old-fashioned way. And the fact that you can match up with one digital currency to another, right, without that currency exchange necessarily being this crazy widespread. Wow. So from a cross-border perspective, that's really where the value is. So obviously banks are going to be on borders. The bank I'm on the board of is in Miami. Yeah, it's the capital of South America, right? So if we can figure it out. We're spending a lot of time trying to figure it out. But the regulatory framework isn't there yet, for sure. There's going to be time. There'll be mistakes made. But the value is really to the big retailers, and the value is cross-border, and the rest of it, look, anybody buy anything with a Bitcoin lately? You still can't do it. It's still really clunky, inelegant. Citibank, like if you think about who's really going to get hurt, Citibank's going to get hurt, right? Because they're going to have to offer it. and they make a ton of money on FX, right? Talk about the slippage, profitability for cross-border, global companies is probably going to increase because of the existence of this product. But again, it's going to take some time. We're all over it. We're spending time on it. But, other than VersaBank actually benefiting from it just by having it already. By the way, the OCC has allowed them to test it. So they're already doing tests, doing very small dollar transactions just to make sure everything works. But yeah, it's coming. It's going to be uneasy at its birth, and there'll be mistakes made. But again, there is fear in boardrooms going, we don't know, we don't understand. Quite frankly, they do understand, because it's just not that obvious. The use is there. And by the way, they will make money from it. I mean, there could literally be thousands of stable coins out there, But by the way, there's not an unlimited amount of short-term treasuries, right? That's where one piece of collateral, another piece of collateral is cash. Well, again, what are you earning on that cash? So it's coming. There'll be more to know, more to do, but like I said, it's not immediate, and you need a really good regulatory framework.
And we got a little bit of the regulatory framework, but talking to a bank CEO who's actively looking to launch, it's a neobank CEO that we're not invested in, looking to launch a stablecoin. He got 5 pitches from stablecoin issuers, and all of them said that he could do different things. So like we're still early, right? When he's receiving inconsistent messages on what's allowed and what's not allowed when we actually have a regulatory framework. So early innings, and to Senior's point, it's right. There's a retail use case. For the consumer use case, it's kind of challenging. Why do I need to use stablecoins? So we got some time.
How about credit card delinquencies? What's your level of concern there for the regionals?
For our stuff, almost none, right? I would say the big banks and the monolines have totally captured the consumer, on the credit card space. So it's marginally small business. Basically, our banks may have credit cards, not necessarily consumers, for businesses just to facilitate, but it's not a big line of business. Do I worry about consumers and consumer credit? Sure. That's what the Fed is worried about when they're not saying it. But at the end of the day, lower interest rates will be helpful for job creation, job stabilization. AI is going to take a lot of jobs. So I do not like the consumer space. We think companies like Affirm and Upstart are very, very dangerous. They don't understand the risk they're taking. And when I say that, you go to a meeting with Upstart and they're arrogant as hell and they go, we have no bankers that work for us and we love it. Yeah, good. Then they say, we have all these statistics. Yeah, they go back to 2010. Terrific. Well, the last time there was a credit issue, and it wasn't in 2010. And we definitely worry about it. And we also worry about the sort of the lack of reporting in terms of the debt that's out there in this buy now, pay later. It's not really recorded, and there's no clearinghouse for it. There's no central, oh my gosh, here's the number. So when you look at consumer credit statistics, they're understating the real amount of debt the consumer has. And there's obviously a certain segment of the consumer population that never intends to pay back the buy now, pay later.
And one interest, Fair Isaac's done a study to see how buy now, pay later would impact credit scores. Believe it or not, it would send credit scores higher if you have buy now, pay later loans, because the people most likely to take buy now, pay later loans are first-time borrowers, right? So it's establishing a credit score. So increasing your debt load would put the total FICO score of the U.S. higher. Makes a ton of sense, right? Concerning. The only headline that I've seen of a large consumer loss that's like material in the last 6 months has been Klarna, right? Who's going into an IPO. It's going to do great. Like, right? It's these fintech borrowers where it's like, if you're scared about the low end consumer, you don't need to worry about Equity Bank and Wichita, Kansas. You need to worry about the Affirms of the world, maybe some of the credit card companies, but probably not even them, because they're not really, they don't have exposure to the low end consumer. We've been concerned about the absolute bottom consumer for a while and they haven't cracked yet, so still showing some resiliency. But I don't think banks are where you're going to see it, right? Since COVID, just the success of fintech lenders has been pretty strong. How do you get market share, right? Part of it's just adverse selection, right? I think they like to make a big deal of they're targeting the unbanked or people who can't get credit. Sometimes those people can't get credit for a reason, and banks don't want them as clients. So that's where I would have concerns on lower end consumers turning over.
All right, next is what are the most profitable lines of business for small banks? This gentleman was concerned that they are increasingly disintermediated as more commercial business moves to platforms with less cumbersome cash management and more yield on cash.
All right. Well, a great question. I'm going to let Dan chime in as well, but I'll make a couple of comments. First of all, there's all these lending platforms out there, and it sounds like a terrible threat. However, their interest rates are much higher. Maybe they're faster. What's their credit quality going to end up looking like, right? Again, Anton Jr. used the word adverse selection on the consumer. It's adverse selection on businesses, right? If a bank's going to charge you 6% and Apollo's going to charge you 8%, you're willing to do some work to make sure you get that 6%. If you don't qualify for the 6%, you'll take the 8%. So they're not close enough. And by the way, I do worry about those lenders because at the end of the day, capital markets are wide open right now. You can get all the funding you want, whether it's issuing stock or issuing debt. If you've got a turn, and we don't expect that turn anytime soon, but if you get a turn in the economy, those channels shut down and then they stop lending. BDCs are already having a lot of credit problems from adverse credit selection. You're seeing most BDCs trade below tangible book value, and the worst trade at a fraction of tangible book value, Prospect being one of them. So yeah, that adverse selection is one of those things. Is there a lot of competition for the loans that JP Morgan syndicates up at the top? Sure. Yeah, I mean, Apollo can lend you money at the same rate, but that's not where we invest. Our consumer, our business banks are lending basically between 6 and 8%, and they're getting covenants, they're getting cash management, they're getting other products. The customer is much more profitable than just the loan. Dan, why don't you take business lending a little bit?
All right. Anton kept referring to Apollo. You could throw in Ares, or you could look at their BDC subs. Their portfolios, if you were to rank, AAA through C, and banks tend to be A through B. These guys are B through C. So it's a credit that they tend not to want, but much more importantly, they're much bigger deals than the ones that we're looking at. So the attachment points for a BDC, depending upon who you are, might be 20 million. It's probably a little higher. And if you're Apollo, obviously it's much bigger. Now, underlying that Apollo loan or credit is money from JP Morgan, Citi, and what we used to call money center banks, because growth for spread lending for them is non-depository financial institutions, which you'll see shortened into the Wall Street Journal as NDFIs. So if we look at our portfolio, the ELCO portfolio, which we'll say is mainly sub 25 billion in total assets, their loan size, their sweet spot is 1 to 3 million. And if you're a BDC with 3 billion, or Apollo with $750 billion of credit availability, that's a lot of loans you have to do in order to consume that capital. So at the moment, and I don't see it for a long time, the profitable aspect for banks, commercial real estate, some business lending, between 1 and 3, 1 and 5 million, there are not many pools of capital that can really compete against it on price, on service, on longevity, on relationship, and other services they can sell into that client base.
And the other thing I would note, just specifically in the ELCO portfolio, if I just go down the list of names here, maybe with the exception of VersaBank, all of them would describe themselves as relationship banks, right? And that's what value they bring, right? Outside of the products that they can offer, products and services they can offer. Apollo doesn't care about you, right? Or any of these BDCs. So for small banks that are regionally focused like ours, they're able to have relationships in their markets, and they are built for that, right? If you're like a small business who's looking for a national player that just makes your life marginally easier, you're probably not looking at any of the banks in our portfolio anyways. You're probably looking at a money center bank. So I'm not even sure there's market overlap on those commercial businesses, with regards to it's really small cap banks, BDCs, and Apollos, Ares, KKRs.
Right. And I want to be, we have two more questions. I want to be mindful of everyone's time here. Are there any small banks involved in international fund transfer for crypto owners who want 24/7, 365 liquidity?
Not yet.
Not in our portfolio.
Not yet. Not in our
Not yet.
portfolio. I don't think anybody's. I mean, the regulators obviously are getting more and more favorable towards the crypto, given the administration. But look, the only bank that's going to be close, and again, it's going to be relatively conservative, will be VersaBank. I mean, they'll eventually get there, but it's less to the trader and it's more towards business transactions.
Got it.
Cross border.
Got it. How about the impact of data center growth, affiliated with AI? How's that affecting the portfolio?
So, I mean, I think it's a growth factor, right? I mean, where are you building these data centers, right? You're building them in places that have land, right? In places that don't have high property values. And these data centers are so big, it's like you could take a skyscraper in New York and lay it on its side. And that's how big some of these data centers are. And there's a lot of money being spent by a lot of people, including banks, right? I mean, banks are building some tremendous data centers. They really aren't going to come online until like 27. But nevertheless, it's great economic activity, certainly driving a lot of tech spending. We actually like the Midwest in a lot of ways. We like it from an onshoring perspective. Data centers are going to places like the Midwest where there's plenty of land. So yeah, I mean, it's a big part of economic growth, and I think it's one of the drivers today. And where we're not seeing obviously activity from companies that are affected by tariffs, which a lot of them are. Data centers are not, right. Right now, they're just like, hey, we need to have this ability. Obviously, generation capabilities to provide power for those data centers will matter as well and provide economic activity. So there are definitely lots of places that are not necessarily big population centers that are getting tons and tons of economic activity. So we feel very good about some of the forgotten places in this world. Junior mentioned Equity Bank, which is headquartered in Wichita. They just bought a bank in Omaha. And by the way, the stock went up on that deal. The deal is very good for equity shareholders. They have a history of they've done 15 deals since they IPO'd, and the company's earnings just keep going higher. So, that's the type of company that might benefit from economic activity in places that you might not necessarily imagine are hotbeds.
Well, guys, thank you. Anton, I like how you said before it's on. Maybe you can just conclude and summarize here for everyone on the call and your thoughts going forward.
Sure. So unless there's some overlying, incredibly bad macro thing, let me list the ways, and Junior and Dan can chime in if I miss a few. But M&A, favorable regulatory environment, favorable valuation environment, favorable gap to valuation, a Fed that's accommodating, and an economy that's still performing. If I had to draw up a wish list of things I wanted, I kind of got them all. So
it's interesting. I'll just interject a little bit. Like, we put those exact bullet points out, when Trump got elected.
Exactly.
And I think there is a really quick, hey, why isn't this happening quickly? It took a little bit of time to play out, right? For regulations to get in place, regulators to get in place before M&A could get going, before we could, have some policy revisions that made M&A easier and everyone happier in the industry. But those are those are the bullet points we laid out late last year, right? So, that's just happening.
So I'll further that. financial services, generally, banks specifically, are cyclicals. Cycles take time to begin, like Anton Jr. just said, and they can last a fairly long time. So if one's willing to put capital to work and let it grow, we're 3 or 4 quarters into this move, and they tend to be 6 to 8 quarters long. So we're barely halfway there. And that suggests that there's still a fair amount of appreciation in front of us from M&A, from operating leverage, and from a regulatory environment that says, let's go.
I want to make one last point about risk. A lot of people were really afraid of office real estate. And one person got on CNBC and said 2,000 banks were going to fail. The number of failures related to commercial real estate are zero. And that's one thing. And then if you talk to some of the bigger banks that actually do have some exposure to office, they're using the word seventh inning in terms of how far along we are here. So we're still not stepping into any banks that are specific to commercial real estate, but one of the worst ones we know, Eagle Bank in Washington, D.C. area, trades at 45% of book value, actually earns money every quarter, and has to keep setting aside a ton of money in reserves, right? Its portfolio keeps having losses and charges, and it still earns its way through it. Will they fail? I doubt it. We're not touching it, right? But that's the kind of name we're watching as the canary in the coal mine, and that canary is still alive and flying. And that's as bad a poster child as I could find.
Well, guys, I really appreciate your time today, Dan, Anton Jr. Yeah, everyone on the call, what's great about these guys, if we didn't address any of your questions, the team here is always accessible. So that's one of the things that makes this a nice relationship. So we appreciate you guys, appreciate the time, and thank you everyone for joining us today.
Thanks, everybody.
Take care.
Take care, y'all.
Thank you.
Take care.